Welcome to topic 7 of applied portfolio management on the topic of momentum investing. So in last week's lecture we looked at Markowitz's portfolio selection, and we ended that lecture by discussing that one problem with that particular approach is that we rely on our estimation of expected returns, and most particularly we rely on the use of the CAPM to estimate expected returns. And we identified this as a problem because the CAPM is an imperfect model of expected returns. So what we're looking at this week is one of several additional factors that have been proposed that might also explain expected returns that should be incorporated into pricing models to give us a better measure of expected returns and hence better frame that Markowitz portfolio selection. So critics of Markowitz's portfolio selection argue that it's quite a limited approach given that it does view investing through the lens of the CAPM. The fact is that Markowitz assumes that all expected returns can be explained by a single factor, that single factor being beta. However, we know that investors' utility preferences are likely to be far more sophisticated than the simple assumptions of mean variance utility. And we also know that it's likely that there are several different multivariate risk factors that explain returns related to our changing preferences over different periods of consumption needs. So, given this evidence, smart beta investing is an approach whereby we say, well, maybe there are more than one factor that explains expected returns, and maybe we can increase our expected return by gaining exposure to those factors. So, intuitively, this approach is appealing. Intuitively, it makes sense that there would be more than one factor to explain expected returns, and empirical evidence supports this in that the CAPM only tends to explain about 30% of the variation in returns. The difficulty, though, when it comes to smart beta investing is to identify what smart beta factors are actually relevant. So what are these additional factors? Well, smart beta investing proposes that there are several potential factors that may explain returns. These factors include momentum, value, growth, low volatility, and quality. And the idea being that investing in what is still a passive investment strategy as opposed to an active investment strategy, but a passive investment strategy that is skewed such that it has greater exposure to these factors will actually result in higher expected returns. So the main smart beta factor, or the most pervasive and most robust smart beta factor that has been proposed, is momentum. Momentum is a relatively simple idea that seems very much at odds with the efficient market hypothesis. Momentum is the idea that we can actually use past prices to explain expected future returns. Now we know that Gene Farmer back in 1970, when he first developed the efficient market hypothesis, made a very clear statement. He said that markets are strongly weak form efficient, and weak form efficiency means that future prices cannot be predicted by analysing prices from the past. However, today we know that there is quite significant evidence of momentum in stock returns. So what is momentum? Well, there are two different approaches to momentum. They are time series momentum and cross-sectional momentum. We'll start with cross-sectional momentum because it's the one that tends to get the most evidence in terms of research, and it's the one that several fund managers will be adopting. Cross-sectional momentum is an investment strategy whereby you rank stocks based on their performance over the intermediate past. And by intermediate past, I mean a period of 3 to 12 months. So you rank stocks based on their performance on some time interval, might be 3, might be 6, might be 12 months. The variation on that formation period is where investors introduce subtle differences into their approach. And it's the idea that, let's say we take the last 12 months returns, we've ranked all stocks based on performance over the last 12 months. Stocks that have performed best over that past return period tend to continue to outperform the market over the subsequent 12 months, whereas stocks that performed relatively worst over that last 12 months tend to underperform. Hence what we do is we take a long position, or we buy those stocks that have performed best over the last 12 months, and we sell those stocks that performed worst. Now this is called a cross-sectional momentum strategy because we are interested in the relative performance, not the total or overall performance of these stocks. So by relative performance, I mean we are ranking the stocks based on their past performance relative to their peers. It could well be that every stock in the market generated a negative return over our formation period. However, we are implicitly buying those stocks with the least negative return. We're characterising those as our past winners, the best performing past stocks. And we would be, in that particular sense, selling the stocks with the most negative past returns. So that's cross-sectional momentum, and there's a significant amount of evidence that shows in the US market, Australian market, and in fact across a vast range of different asset classes, are significant evidence to support the existence of cross-sectional momentum. The second approach to momentum investing is time series momentum. Rather than looking at stock return performance relative to its peers, time series momentum looks at stocks returns compared to its own time series. So it's an even more simple approach to investing, whereby an investor will buy those stocks that have had a positive abnormal return or positive return performance over the period of be that 6 or 12 months, and it will sell those stocks that have had a negative performance over the period of portfolio formation. So it's a subtle difference. You're not comparing returns to the peers. What you're doing is just looking at the stock's own time series and buying or selling those with a positive and negative return respectively. There's also quite substantial evidence of time series momentum within financial markets. So the second question, if we're going to incorporate momentum as an investment strategy, then it must align with our investment philosophy. So the question is, well, what type of investment philosophy would justify an investment in momentum? Well, there are three major explanations as to why we might see momentum in stock returns. Those major explanations are, first of all, risk. Okay, so some people argue that past winners are just systematically riskier than past losers. Hence, momentum is just a strategy for identifying riskier stocks, and obviously riskier stocks should have higher expected returns, and we just find that the returns that are generated are a function of that difference in risk. However, the problem is that a whole lot of research that's examined this particular question has found that there's not strong evidence to support the notion that past winners are riskier than past losers. This is particularly the case when we look at in the mean variance framework, because in particular, if we compare past winners to past winners tend to have lower standard deviation of returns and lower beta compared to past losers. So if anything, past winners are actually less risky as opposed to more risky. An alternative risk-based explanation, though, might be able to be derived if we assume that investors had different utility preferences that aren't following the mean variance preferences. Because one feature that we do know about the momentum investment strategy is that it does suffer from infrequent but very large negative drawdowns. We saw one in 2009, March to May 2009, the momentum investment strategy lost approximately 50%. And these infrequent large negative drawdowns actually result in the momentum return distribution being negatively skewed. If we look at returns on portfolios of winners versus losers, we actually see evidence of this. Past losers, so stocks that are ranked poorly based on past performance, those portfolios tend to exhibit positive skewness. Whereas portfolios of past winners, the subsequent returns actually tend to be negatively skewed. So if we apply some alternative utility theory such as prospect theory, there actually may be support for the proposition that winners are riskier than losers, and that's one potential justification. So one investment philosophy that could be consistent with using momentum as an investment strategy is if you believe that investors do have preferences for higher moments, such as those predicted by prospect theory, and hence investment strategies that are exposed to negative skewness should earn higher returns, because we do know that the momentum investment strategy does have a negatively skewed return distribution. The second group of explanations for momentum are based on the perspective that markets are less than perfectly efficient. So The next two explanations are both behavioural based, and the first is underreaction to information. So this is the idea that individuals are slow to update their beliefs. Therefore, when new information arrives within the market, the investors will underreact to that information and the price will only gradually move to fair value. So let's say, for example, good news is released regarding stock. The price will increase by a small amount, but not the full intrinsic value of that positive announcement. And then gradually over the next few months, there'll be a price continuation as the price continues to move until it gets to its long-run equilibrium value. So if investors did underreact to information, we would actually expect to see a continuation of returns. Hence, we would expect to see momentum. So this is a behavioural explanation if you believe that markets are less than perfectly efficient, and if you believe that investors do tend to underreact to information, that could be a further justification for momentum. The problem with using underreaction alone as an explanation for momentum is that there is one aspect of momentum returns that don't appear to be consistent with that hypothesis. That is, if we look at momentum returns, if you invest in winners, buy past winners and sell past losers, what we tend to do with a momentum strategy is rebalance our portfolio every 12 months. That is, at the end of each year, we will reassess which stocks were the winners, which stocks were the losers, and we'll adjust the constituents of our buy and sell positions accordingly so that we continue to have exposure to those most recent winners and losers. However, if you don't rebalance, and if you hold that portfolio, instead of rebalancing every year, hold it for say 5 years, what we find is that stocks that were past winners tend to outperform over the first year after we form that portfolio, but actually tend to subsequently underperform over the next 4 years, such that over the long run, over say a 5-year holding period, stocks that were losers in our evaluation period tend to actually outperform over the long run, and stocks that were winners actually tend to underperform. So we see what we call mean reversion. We get past winners having continued positive returns over the first year, but then negative returns over the next 4 years. Now, the underreaction explanation for momentum is not consistent with that mean reversion. Underreaction should just be price continuation, not price continuation then mean reversion. Therefore, researchers have built on that underreaction hypothesis and suggested maybe momentum is actually explained by market behaviour where there's actually a combination of both underreaction to information or to news releases, but overreaction to prices. So this theory, which was introduced by Barbera, Schleifer and Vishny, as well as Hong and Stein, is based on the notion that financial markets are comprised two main groups of investors. Those two main groups of investors are basically price traders or noise traders and information traders. So the information traders, they're trading on information that's released. The price traders, they're trading based on technical signals or based on changes in prices. And new information's released and the information traders will trade on that information, but consistent with our behavioural views and consistent with how we see people act, investors will underreact to the information. So we see the price continuation that we spoke about in the previous theory. However, when that price continuation occurs, so there's a sort of an upward trend in prices, this is when the technical traders or the price followers get excited because they see continued upward movement in prices and they're trading based on price movement, so they extrapolate that trend and they continue to buy, which actually causes the price to overreact. So not only does the price finally get to its fundamental value, but it continues to move beyond it such that it becomes overpriced. In the long run, market equilibrium should be restored so that that price will recede back to its fair fundamental value. But this combination of both underreaction and overreaction fits in with our understanding of what we know are some of the behavioural biases that we see within investors, and also fits in with some of the empirical evidence around the time pattern of returns we see with the momentum investment strategy. So the most common explanation and phenomena is that there are behavioural biases, markets are less than perfectly efficient, and because investors are susceptible to underreacting to new news and overreacting to prices, this might cause the pattern of returns that we know as momentum, and this might be why momentum can be used as a successful trading strategy. Now, we spoke earlier about both cross-sectional and time series momentum, and the time series momentum particularly is related to traditional technical analysis. So technical analysis is whereby investors use signals from past prices to predict future returns. So there are different ways that technical analysis can be used by investors, but in effect, it's the idea that prices are not necessarily totally rational, and hence the price, because it's driven by supply and demand as opposed to purely just firm fundamentals, if you can identify the factors that are driving that supply and demand, you might be able to predict future prices. So some of the technical signals that are used include market breadth, which is a measure of the number of stocks in the market that have increased in value relatively to those that have decreased in value. Volume indicators, where there's a high volume of trading in a particular stock, that indicates that there might be high demand for that stock. And in fact, evidence suggests that momentum strategies may be stronger where volume is larger. And also the use of support and resistance lines, whereby technical analysts will use a form of charting to identify trends in prices, and when a share price falls out of that trend, it will predict the movement into a new trend, and they'll trade based on that new trend. Now, while the discussion around technical signals may have some economic justification, we actually find technical signals don't work as well as the traditional momentum strategies. So momentum itself does tend to be the best way to pick up predictability in terms of prices. So taken as a whole, what does this mean? Well, we see very strong evidence in academic research and also in terms of the performance of funds that use this particular approach to investing, that momentum is related to expected return. That is, sorting stocks based on their past return performance, past winners do tend to outperform past losers over the subsequent investment period. So if we think back to Markowitz portfolio selection, what we can now think is perhaps we can come up with a way of better estimating expected returns by not only focusing on beta, but also potentially incorporating momentum into our factor model. And we can do that two ways. We can either screen the universe of feasible stocks and only identify those that are past winners, because we believe past winners will perform better, or we can provide some sort of premium or additional loading in terms of our expected return calculation for stocks that have performed positively over the intermediate past versus those stocks that have performed poorly. Thank you for listening to this lecture summary on the topic of momentum.